Welcome to Kitchen Table Finance.
Dave Shotwell, welcome back to the show, my friend.
Hey,
It's been a month or so. We've had some fill-ins for you. It's good to have you back.
yeah, well, it's
For
good to be
sure.
here. Good to
Well,
be
I am
here.
glad you're here. We've got a great topic today. It's been all over the news. It seems to be all I talk about lately,
Right,
and that is the Fed, the Fed, the Fed. Not since
right.
Greenspan was carrying around his briefcase have we had this much coverage on the Fed.
Well, if everybody else is talking about it, I guess we better talk about it too, right?
That's right. That's right. So I guess let's start out with, because a lot of our listeners, I'm sure, have heard about the Fed, but probably don't know necessarily the structure and the history behind it. So why don't you give us a little history lesson and teach us about what the Fed is and why they're around?
Nobody that doesn't have to think about the Fed should have to know this stuff. But
Seriously.
so the Fed was created, way back in 1913 by the Federal Reserve Act. So it's been around a while. Kind of the role has evolved a little bit since 1913, but during the 30s, legislation was passed that strengthened the authority and the independence of the Fed. The idea for the Fed is that there's four roles enumerated for the Fed, but two of them are really what we focus on mostly these days.
Yes.
But their role is to strengthen and stabilize the banking system and maximizing employment is one mandate, with the other main mandate being keeping prices stable. I guess the fourth one is they act as a regulator for certain banks too, depending on their charter.
Sure.
But
Yeah.
those two, the maximizing employment and keeping prices stable, in other words, combating inflation, right, or deflation,
Yeah. Mm-hmm.
are the two that we really focus on from a financial planning standpoint.
Yep.
And the main thing, to keep in mind is those are kind of competing interests, right?
Yeah. Exactly.
Right. So maximizing employment, that's great. That means keeping the economy growing, keeping
Mm-hmm.
companies in a position where they can continue hiring. The flip side of that is an economy that's growing too fast and too hot creates inflation.
Right.
So you really get the Fed kind of playing the Goldilocks role of trying to prevent the economy from being too hot, where we have inflation, or too cold, where we have layoffs or lack of job creation.
Yeah, and part of the reason why it has become such a hot button topic, well, there's several different reasons, I should say, but it kind of came into more prominence lately with the inflation talk of,
Mm-hmm.
that increasing rate cycle and how do we get inflation down? And then all of a sudden people had to start paying attention to the Fed again a couple of years
Yes.
ago, and we've got more of that this year, and now we're going the other way with labor slowing down, which we'll talk about a little bit later of kind of what they're doing. But that's kind of why we are seeing and hearing so much about them right now.
Right. Well, and a lot of the focus has been on independence of the Fed and the political
Mm-hmm.
implications of growing the economy in the short run versus inflation in the long run. And
Yeah.
so a little bit about the structure of the Fed might help, shed some light on
Yeah.
how that independence works. But essentially, there's 12 regional Federal Reserve banks, and each, has its
Mm-hmm.
own president who provides data and insights for their region on what's going on in the
Mm-hmm.
economy. And then there's the Federal Reserve Board of Governors, which is 7 members nominated by the president, confirmed by the Senate, and the Federal Open Market Committee, which is 19 members who actually set interest rate policy. Only 19, I'm sorry, only 12 of those 19 vote at any one time. It includes the 7 Fed governors. The New York Fed president is always a member of the voting
Mm-hmm.
group, and then 4 rotating members from those regional presidents kind of make up the Federal Open Market Committee. The chairman, who's been the focus lately, Jerome Powell,
Hmm.
um, been called out by the president and the administration for keeping rates too high. He only has one vote. He's not like super
Mm-hmm.
powerful. He has one vote. He has no veto power. He's really, I guess the best way to think about him is maybe as the appointed like the appointed spokesperson, more or less,
Yeah.
right? Yeah. Yeah. The
Kind of a
one,
crappy job, especially lately.
right, right. Well, yeah, he gets none of the upside of being in charge, right? But
Yeah,
all the downside of having everybody think he's in charge.
exactly.
So, so, so it's interesting when so much is made about independence that it's this kind of like big
Hmm.
nebulous group spread all over the country. Um, but he's kind of become the lightning rod for the administration's position that interest rates should be lower to stimulate the economy, while the Federal Reserve and Chairman Powell's remarks over the course of the summer have focused on, well, the economy still seems to be fairly strong and doesn't need us to cut rates to
Right.
stimulate it. And we don't know what the effect of the tariff situation is going to be, and we expect that's going to cause inflation.
Yeah, and so you have this situation where, and this is not anything new in terms of the White House wanting to put pressure on the Fed chairman to do what they want, right? Because you
No,
have
it's not
this,
new. Yeah.
you have this underlying thought that, and the reason for the independence and why it's so important is you want them to focus on the long run of the economy, not necessarily what's
Right.
good in the next 6 to 12 months, because
Or four
that, from a
years.
political
Yeah.
standpoint, hey, it's election time. Let's cut all the rates and make everything
Yeah.
seem really good, so we can all get elected again, and then to hell with what happens in the
Yeah.
next 24 to 48 months.
Yeah. Yeah. Well, a good corollary is deficit spending in a way, because no politician wants to cut spending. They want future Congress to have to deal with
Right.
spending cuts and tax increases, right? So kind of the same thing. Let's stimulate the economy now, get the job numbers up, make everybody happy in the short run, and let the future politicians deal with the fallout of inflation.
Right.
Yeah. So we need that insulation, that protection from politics, if we can get it. And in a way, like in the broader sense, the role of the Fed provides stability for our currency, which is based on faith, right?
Yeah.
And credibility. And if the
Hmm.
rest of the world feels that the Federal Reserve is just a tool of whichever political party is in power at that moment, and this can go both ways, I'm not singling out either one, then
Oh yeah.
we lose that credibility, right? And
Right. Hmm.
part of our position in the world and why our economy is positioned to do as well as it does is our role as the reserve treasury currency for the whole world.
Hmm.
So,
Hmm.
that's where that independence really becomes important.
Well, the other part of this too is, like you said, that faith of, that the Fed's going to act in the best long-term interest of the economy. And the problem is, if people start losing faith that the Fed is going to control inflation, they're just going to start assuming that inflation is here, and
Right.
they're going to start behaving that way, and it's going to be a self-fulfilling prophecy, right?
Well, right. Ask any Argentinian what it means
Yeah.
when the whole country loses faith in their currency and you
Yeah.
see, triple digit inflation. It's that's the end result of that lack of credibility. And there's not much, once it's gone, there's almost nothing you can do to get it back.
Oh yeah, and it's been if you look at some of these countries that where there isn't the independence, you see those
Yeah.
results. It's pretty
Yeah.
cut and dry as far as what that looks like in other countries. So
Right.
super important.
There's tons if you look back, well, you look back over our careers anyway, there's always been plenty of criticism of the Fed. And
Oh,
they
for
were either
sure.
too late to lower interest rates when a crisis was brewing, too slow to lower interest rates, lowered interest rates too soon in different situations. They're never. It's a thankless job that they're never going to get right, because in retrospect, it's always going to look like they could always have done it better, right?
Right. Oh, for sure.
And macroeconomics is just a murky, dismal science. That's all there is to it. There's no
Yeah.
the reason there's all these folks on the Federal Open Market Committee from across the country is to try to get a feel, so the Fed as a whole has an idea of what's going on in the Pacific Northwest, as well as California and New York and Ames, Iowa,
Yeah.
because we just don't we just it's just a very, very difficult task, very difficult task.
Well, it's trying to predict the future, right? It's in
Right.
hindsight, it's super easy to go back in time and say,
Yeah.
yeah, we probably should have done that differently, right?
Yeah. Yeah. Yeah.
Unfortunately, there's no, it's, we don't have Back to the Future. We can't send Biff
Yeah.
back with the book of all the results of all the games. You know what I mean? And so,
It's like me trying to predict how Nick and Michelle Nada are going to spend their money for the next 6 months times 3 million or 300
right.
million, other Americans. All the little decisions. How are we going to think and act? How are all the small business owners going to behave?
Oh, yeah.
you know um, how are manufacturing companies going to behave in this environment? And then you've got all the potential external shocks that you just can't account for. you know so so anyway, thankless job, requires independence, but an important role in the economy for sure.
Yeah. Yeah. Absolutely. So now that we've kind of explained a little bit about the Fed and what it does, why don't we delve into what this means for people and kind of their portfolio? What is
Sure.
the outcome of starting to cut rates?
From a functional standpoint, we've got to also keep in mind that what the Fed controls is essentially the interest rates that banks charge each other, or the Federal Reserve charges banks for very short-term loans to fund their reserves, right?
Right. Hmm.
So it's not like the Fed can go out and set your mortgage rates or
Right.
set your savings account rate. Those are all determined by the market. Now, the Fed moves in short-term interest rates that they do control do affect all those things, but not directly and not one for one. Those are all determined by the market, and that's
Yeah.
I think an important distinction. A lot of people don't quite get that.
No, there's definitely a disconnect between, well, the Fed lowered interest rates, so that
So
means
yeah,
that,
yeah,
treasury rates are lower or mortgage rates are lower.
right.
Kind of, but they didn't actually set those rates.
So you and your portfolio, and your finances. There's an old cliche that, um, is a cliche for good reasons. Don't fight the Fed. So when the
Hmm.
Fed is lowering interest rates, we'd expect that's going to be stimulative to the economy and good for the markets in general, right?
Yep. Hmm.
So you don't want to, don't don't fight the Fed with your portfolio. Is an old cliche. We don't make changes based on what we think the Fed is going to do anyway, because it's very, very hard to predict.
Yeah. I always found this interesting too because the Fed cutting interest rates is kind of a signal that things aren't going very well.
Right.
But you got to remember that the market is looking at like what the next 6 months
Yeah.
are going to do and not necessarily what's going on today.
Well, and that's an interesting distinction between lowering rates right now and lowering rates in other times in our careers, right? I
Mm-hmm.
mean,
For sure.
um, usually when I think of the Fed lowering interest rates, it's because, holy cow, Lehman Brothers and Bear Stearns just collapsed, and
Yeah.
we're in the middle
Right.
of the great financial crisis, and if the Fed basically took rates to zero, and then did some other things that effectively were trying to take rates below zero to stimulate the
Right. Yeah.
economy. It was the financial equivalent of electroshock paddles for a a
Right.
cardiac arrest. So this is a little different in that they're lowering interest rates right now as kind of a preventative measure,
Yeah.
that they
Hmm.
fear that the so I think when we talk about that aspect of it, that yeah, usually they're lowering rates when the economy is lousy. That is, it's almost like they're reacting to something at that point. It's almost
Right.
too,
Yes.
they weren't being preventative. So
Hmm.
when it comes to your portfolio, usually the damage has already been done, right? The uh,
Right.
the
Yeah.
the Fed is lowering rates because of the things that have already affected your portfolio. And
Hmm.
so don't fight the Fed in that sense means don't like get out of the market expecting more damage. If the Fed is lowering rates, it's probably going to stimulate the economy and we'd see some kind of recovery, right?
Yeah. So let's talk a little bit, if we could, about the current situation, because, like you said, it's different than other times in our career, but it's
Yeah.
also, and part of the reason is the Fed has been concerned about inflation for a while, and their goal, their mandate, if you will, is to have 2% inflation, and we're not at 2%, and there's still some inflationary risks out there, and they
Mm-hmm.
basically have one tool, one lever that they can pull to help the labor market, but unfortunately that also potentially brings on more inflation, and so we're kind of
Right.
in this sticky spot right now of how fast do you pull the lever down, and how does that affect the other side of it, the seesaw, so to speak.
Yeah. Yeah. And well, it's not a job I would want to have, but they're
Yeah.
trying to thread that needle between expected. We are seeing signs of weakness in the job market over the last
Hmm.
6 weeks or so, 2 months. Revisions downward in last year's assumptions, and it just does not seem like a very strong labor market right now overall. But the economy doesn't seem particularly weak either. It's kind of
Right.
coming from a very strong spot to a potential weaker spot. So yeah, we're not trying to stave off some kind of disaster here, from as far as we can see, and at the same time, everybody is still waiting to see how the tariffs are going to play out in terms of inflation. And if
Hmm.
you if we start to see inflation caused by tariffs, and at the same time the Fed is lowering rates, that's potentially dangerous for down the road. Again, kind of finding that Goldilocks mix. But I guess one way to think about what's going on right now is they're basically signaling that they're willing to be, um, in finance terms, they call it dovish and hawkish in terms of inflation, with inflation hawks being folks that would um, raise interest rates to stave off inflation as the highest priority, where the doves would be those who would not worry about inflation as much as keeping the labor market strong. So they're kind of leaning that direction, is what this is signaling.
Yeah, and it's kind of been in a shift, and some of the comments were, right now the main focus is trying to, support stronger labor markets, because those numbers are kind of moving in the wrong direction. But just like anything, things can shift quickly. And
Right.
so, like you said, thankless job. We won't know until, 6 to 12 months, maybe even longer from now, whether or not they're making the right moves or not,
Yeah.
because we just don't have that kind of information. So they're doing what they think is best with the information they have right now. So, what does this all mean for people gearing up for retirement, and just kind of thinking through, like, are there things you should be doing right now? How should you think about this? Where does that leave you if you're thinking about retiring in the next, 12, 6, 12, 18 months?
Well, you know, overall, um, we would expect a lowering rate environment as long as the Fed doesn't miss the mark on inflation would be good for the markets. It's good for stocks in that companies make more money. They have lower costs of capital. They can hire more people, which in turn stimulates the economy. And that's generally a good environment. It's a good environment for bonds when interest rates are lower, because essentially new bonds coming out are going to then have lower interest rates most likely, and that will push the value of existing bonds in your portfolio a little bit higher. So that's a good thing.
Mm-hmm. Mm-hmm.
Um, on the other side of the ledger, if you hold a lot of cash in your financial picture and portfolio, you're not likely to make as much on money markets and CDs. We always are working with our clients to figure out what that right amount of cash is. If you're holding more cash than you need, that can be a drag when
Sure.
interest rates are falling, right? Because
Mm-hmm.
for the last little while, we've been enjoying high yield money markets that were in the 4% range, while inflation was at 3%, and we're likely to see those tick down. We've already seen
Yeah.
a few of those tick down here in anticipation of the lower rates.
Right.
If you do like to hold significant amount of cash, you might consider using certificates of deposit in a falling rate environment. Doesn't do you any good in terms of what's happening right now, but it does give you insulation against lower than expected rates going forward, because you're essentially locking
Mm-hmm.
in rates today that you may not be available 12 months from now. In
Right.
the long
Mm-hmm.
run, it comes down to how much you want to keep in money markets versus CDs. You're probably going to end up in a similar place over the long haul, but you can protect yourself from some of those ups and downs using CDs.
I think people tend to generally put too much impetus on that, like you said.
I
Like,
do too.
the problem with the great thing about locking a CD rate is if interest rates go down, like you said, you earn a little bit more, but then you have that reinvestment risk of what happens
Hmm.
at the end of this. And then are you going
Hmm.
to, put that back into a money market account and wait until rates go up to lock it? Like, you're never really going to be able to anticipate the moves of the market and of the interest rate environment. So at the end of the day, you usually end up right back where you started in terms of where your total return is.
Yeah.
But if it makes you feel better to lock in rates, then do it. It's probably not going to be a bad thing right now, but just don't. It's not like this great strategy where we can lock in, get a great rate,
Yeah.
and then you're going to be that much further ahead. And the one other thing that I'll say right now that we see in almost every rate cutting cycle is then all of a sudden you get the people coming out with the guaranteed income folks, if you will,
Hmm.
touting their product, how it's going to give you 5%, it's going to lock you in when everything else goes down to nothing. And the last thing that you want is to get into something that sounds great, because usually if it sounds great, there's other risks associated with it that you're going to
Right.
want to make sure you're aware of.
Those usually don't play out the way people expect them to over the long run. If you've been a borrower over the last couple of years, you may have a
Mm-hmm.
chance to refinance your mortgage. We're probably not there yet, but we do continue to see a downward trend in interest rates. Keep an eye on that, and
Mm-hmm.
now if you borrowed money before 2022, you're probably not going to be refinancing that anytime soon.
Or possibly ever.
Yeah, right, boy, yeah, yeah. But don't. I guess that's a good point. Is we've got to remember that those interest rates, particularly over between 2001 with
Mm-hmm.
some spikes in between in 2022, were abnormally low for history,
Oh yeah.
and we all got used to that pretty fast. And don't expect in this rate cycle, if things stay kind of on the trajectory that they're on, that you're going to see 3% or 2.8575% mortgages anytime soon.
I
Yeah,
mean, not unless something drastic happens with
yeah,
inflation and where it's at, which, counterintuitive that inflation goes down while interest rates are going down. Those
yeah,
things usually
yeah,
don't work that way.
yeah.
But a couple things that I'll say, just kind of a general rule of thumb, because we get this question a lot, is from a refinance standpoint, I usually tell most people to start thinking about it once you're in about that 1% range is a good time to
Right.
like start having those conversations.
Yeah. 1% being, current rates below your current, your
Yeah.
existing rate. Yeah.
So if you got a 7% mortgage, it goes down to 6. You're probably in that ballpark where you can start having those conversations and
Yeah.
looking at how much savings there would be. And I think Freddie Mac came out and said the average 30-year right now is 6.23 or somewhere along there. So,
That sounds
you know,
about right.
depending on what direction things are going. The other thing that's going to be interesting, and we've seen some of this lately too, from the housing market standpoint, is we've got a lot of retirees getting ready to retire, thinking about downsizing and not necessarily wanting to get rid of their 2.5%, 3% mortgage for a 7% mortgage.
Right.
And so as those interest rates come down, it's going to be a little bit easier pill to swallow, rates, payments, things like that, going from 3% to maybe 6%, or as you know, as those numbers come down, we're getting closer to that point too.
Yeah. Also, too, that reminds me of something else that I've read a couple different places lately, and that's about people that bought houses with high mortgages over the last couple of years, assume like that where their payments aren't affordable, but assuming they'd be able to refinance at lower rates by now, and they've used up their savings on these payments they can't afford. And I think that's a good way to kind of put a bow on this conversation. Is you should never trying to predict the trajectory of interest rates and the actions of the Federal Reserve is every bit as difficult as trying to predict the
Yeah.
stock market itself or pretty much anything else in life that we don't control. So make sure, like you should never be buying a house on the assumption that you can refinance it. You buy a house
Yeah.
because everything else fits with a mortgage that you can afford. And if you can't afford it now,
Right.
don't go into it thinking that that day will quickly come.
Yeah, see 2008 for horror stories on buying houses that you couldn't afford the payment on. I think lots of good advice out there. Like we said, the Fed has been all over the news cycle right now, and there's just a lot of anxiety around what they're doing, why they're doing, how it impacts you. And it's another one of those. Yes, you should kind of know what's going on, but also, in a couple of years we're going to have something completely different to talk about, and this is
Right.
not really going to make a major impact on your long-term financial plan, but just make sure you're prepared for it in the short run so that you don't, make a mistake or do something with using emotions as opposed to logic and end up hurting yourself in the long run. So it's my
Exactly.
soap opera speech for today, Dave. It's been great to have you
It
back.
was your turn to make it. Yeah. Yeah, it was good to be back. Knock the rust off a little bit. Get my voice going again. So
There we go. So we will be back in a couple weeks here. To our listeners, if you have questions about rate cuts and how it might impact your retirement, feel free to go on our website at srbadvisors.com and check out the information we have there and schedule a call. With that, Dave, it's been a pleasure.
thanks, Nick.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Zedia Media production.